The US dollar is extending weakness because of a dramatic shift in expectations of more monetary easing in the United States. Now, some market participants foresee a rate cut at the nearest policy meeting in March. Nevertheless, the majority is betting on a rate cut at the end of the second quarter. Ahead of the weekend, traders are poised to buy safe haven assets. Global stock indexes tumbled again due to the mounting number of coronavirus cases in Europe, the UK and the United States. Commodity assets are also trading lower. Meanwhile, the US dollar index hit a 9-month low and having sunk below 97.00 points. The index closed the Asian trade at near 96.50. US Treasuries collapsed to a record low, thus confirming global risk aversion. The yen, the most popular safe haven asset, has firmed to the strongest level since August 2019. The dollar-yen pair dropped below the support level of 106.40. At the moment of recording this video, the currency pair settled down at 105.70. The US currency might fall even deeper to 105.00 against the yen. However, the US non-farm payrolls are on the radar today. In case of upbeat data, analysts expect a short-term correction of the dollar-yen pair to 106.40. At the same time, the Australian dollar is still benefiting from the greenback's weakness. The AUD-USD pair is going to test the level of 0.6650. However, from the fundamental viewpoint, such a price move is of a poor speculative nature, so the currency pair is expected to resume the overall downtrend towards 0.6597 and lower to 0.6435. Yesterday, Australia reported on its trade balance for January. Retail sales data released earlier today confirms low domestic demand. Consumer spending has been contracting as retail sales fell 0.3% in January, worse than the forecast for zero growth. Bearing in mind this information, analysts predict that the Aussie is set to weaken to the lowest level in 11 months. That's all for now. Trade at a profit with InstaForex. Don't miss the next video on our TV channel in a couple of hours. See you later.